All right, for more on these markets, I'm going to bring in Dennis Gartman, the Gartman Letter editor and publisher. And Dennis, you're getting a little worried here.
Well, yes, Trish, I am getting a little bit worried here. I've been worried for a little while. The economy, let's make no bones about it, the economy is doing quite well. Stocks always, however, make their peak at the tops when economic activity is its best. There's a very simple explanation. In good economic environments, when the monetary authorities begin to reduce the supply of reserves to the system that they had been supplying for several years, when they begin the process of taking that back, and when demand for plant, equipment, and labor begins to increase, money comes out of the capital markets, money comes out of equities, and moves into the economy. That is very normal. It is very standard. And then that's how actually material bear markets begin. They begin at the peaks. They begin in volatility. Markets make their lows in quiet, somnolent, boring trading. They make their peaks in rather violent type of activity,
well,
and that's what we have right now. So I think you should be careful. This is the beginning of a bear market.
Let's drill down on that a little bit, because it doesn't, for a lot of viewers watching this right now, it's not making intuitive sense. They're saying to themselves, okay, well, Dennis just told me, companies are going to be spending more on capital equipment. Well, that should be good for the economy. And that the Fed is going to have to, turn the spigot off, which also, in a normal growing economy, is actually the right thing to do. So how does that get you into a bear market?
Trish, at the bottom, what did we have? At the bottom of the economic cycle in 2008, 2009, stocks began to move up long in anticipation of the economy turning for the better, because the monetary authorities were going to force feed reserves into the system. Now we understand that the monetary authorities, whether it's the bank here, the Federal Reserve Bank, whether it's the Bank of England, whether it's the Bank of Canada, whether it's the ECB, are going to be reducing the supply of reserves. So you have that taken away. Plus, again, you have the demand for plant and equipment and labor that is historically quite strong, and that money comes out of, it has to come from someplace to supply those reserves, and it comes out of the capital markets. Stocks anticipate economic upturns. Stocks anticipate economic weakness. That's just how things happen.
We knew it. You look at the wage growth that we've seen recently. This is all good. You look at the tax reform, which is actually going to be helpful to corporate earnings in a pretty meaningful way. So, I understand there's a rotation going on and there are more options, right, for people to put their money, because during the last 8 years, you really didn't have a choice other than to be in equities, right? I mean, the Fed was helping things along. There was really nowhere else you could go. But I just don't know why it's going to create such a tremendous pullback when it's still one of the better games in town.
It is still a great game in town, but it is a lesser game than it had been. No question about it. Earnings have been very strong, but with interest rates going higher, and interest rates are going to go higher, I think you're going to see the 10-year well in excess of 4% 18 months from now. And remember, I think I said here on this program not too long ago, I can remember when the 8s of '86 traded at an 8% coupon and went to a discount. I remember too familiarly when the long bond had a 14.25% coupon. Rates are going to go higher. Are they going to go back to the highs that we saw 2 decades ago? Of course not. But are they going to go higher? Can the 10-year get to a 4% yield in 18 months? Yes, and that's going to be very competitive with the capital markets.
I should point that out. I mean, you get 3.13% right now on the 30, although I still think that's pretty low, Dennis. I mean, come on, 30 years from now, the expectation is you can only get a 3% return on your money if you tie it up for 30 years. It seems kind of pessimistic.
I wouldn't want to tie my money up for 3% for the next 30 years. No question about it. There are wonderful little enterprises, wonderful little equities, wonderful ETFs that are listed on the New York Stock Exchange that yield 7, 8, 9% with a short-term duration. If you're going to go anywhere, go there. I think that people have to take some scrutiny as to what's going on and take some defensive actions. I think otherwise they'd be ill-advised, and I think they'd be upset 6 months to a year from now.
24,431 right now on the Dow. Where do you see this in, say, 6 months?
Can we get under 22,000? Sure. Can we get to 21,000? Perhaps. That would probably be a bit on the down, a little aggressive on the downside. But can we go lower from here? Yes, we can.
Well, then you got some real buys, some real bargains out there, right? Because if you're looking at 17, 18 times earnings right now, if you're down around 13, 14, that's a huge opportunity.
Oh, there will be. There's no question. Bear markets give you great opportunities, bull markets at the end and amidst the volatility give you a reason to move to the sidelines and anticipate those opportunities that shall come sometime in the future, but not in the next month and not in the next 2 months, probably sometime in the next year or so.